a real pleasure to have you all here in one of IBRAC'S meeting to discuss antitrust. And this time we won't talk about big techs and digital markets. I'm happy with that. So we changed subject a little, but we'll talk about the failing firm defense, which is a real important subject that is being discussed all around the world recently due to the COVID pandemic. Of course, we are facing some difficulties, and when I say we say we lawyers and economists and companies, to convince the authorities that due to the COVID, they should, let's say, minimize the risks of using the failing firm defense for the approval of some mergers. Of course, it is very difficult to preview what's going to happen during the next years after the pandemic. We used to think here in Brazil that we would have lots of discussions about companies' cooperation and collaboration, but actually it didn't happen. So we are now on the second phase, let's say, of the discussions, and we need to talk about this, the crisis itself and the effects on the company. So this panel will discuss exactly how much the failing firm defense would affect or will be used by the parties and the authorities in order to analyze or scrutinize proposed mergers in the future. So thank you all to be here. I thank Bruno and Fabi for organizing the panel, and I thank you all the panelists. And please, let's start. Bruno, you have the floor. Thank you very much.
Thank you, Lauro. Welcome, everyone. I think this is another event that we're organizing through IBRAC, trying to have more international events with hearing other jurisdictions that are certainly more mature than Brazil. And it's often very good for us to hear the experiences abroad and compare with what we're doing here. As Lauro mentioned, the failing firm defense is something that has been discussed for a long time. We always find arguments on merger control cases, but it's often a very difficult one and a very difficult one for the authorities to take into consideration. It's very rare to have cases which have been decided on exclusive basis of the failing firm defense. But we certainly face a new challenge, an unprecedented challenge, at least for our generation, which is the post-crisis and how we're going to deal with that. We know that competition is a central pillar for the reconstruction of the Brazilian economy. I think we're going to hear more about this from our commissioner, Sergio. And it's to be seen how the failing firm defense will be taken into account for this new reconstruction pillar for our economy. So without taking more time, just a few announcements here, a few notes. We are going to close the event sharp at noon because, of course, our panelists have other commitments right after. So we're going to be sharp on this. This event is being recorded, and this is going to go for our IBRAC library. Please, all those that are not the panelists or are sitting in our virtual table here, please close your microphones and your cameras so we can focus on the panelists themselves. Fabiana, I'll pass to your initial notes as well.
Okay, thank you everyone. Good morning. So we have a really nice discussion on the falling firm defense. I think it is a really, really hot topic regarding this economic situation that we are facing. I'm going to explain before, talking about the panelists, the structure of the panel. We're going to start with a short overview of the topic for each of the panelists, and then you're going to move forward to debate. We're going to have some questions, and the last 20 minutes or so, we can just open for questions from the audience. So that's going to be our structure of today's seminar. So we have really selected a special panelist today. We have Sergio Ravagnani, which is a commissioner from CADE. He's also he's a lawyer from University of Brasilia. We have Ethel Fonseca, which is economist, a partner at BBA Economics. She's been there since 2008, and she also has a PhD in economics. We have Mário de Oliveira, which is a former commissioner at CADE and also a senior consultant at CRA in Brasilia. He also has a PhD in economics from University of Federal de Rio de Janeiro. And go on, Bruno, to show all the panelists as well.
Sure. And then we have Caio Mário da Silva Pereira Neto, who is a very well-known colleague of ours, a partner of Pereira Neto Macedo Advogados, professor at Fundação Getúlio Vargas, he a former director of SDE, our former authority. And the most important title he has, he's a director of IBRAC as well. Then we have John Taladay, who is a partner and the co-chair of the antitrust practice at Baker Botts. He's also a counsel for the ABA section of antitrust law. And we have and John, of course, he's sitting in Washington, D.C. And then we have Rafique Bachour. He's a partner of Freshfields in Brussels, which he told me that is very sunny and hot, very different from our climate in São Paulo right now. And he's also a co-head of the firm's general industry sector group at Freshfields. So thank you all for accepting this to be part of this debate. And without taking further time from our listeners, I'll pass the word to Commissioner Sergio Ravagnani, so he can tell us a little bit of what's going on with CADE.
Mm-hmm.
Bruno, thank you very much. Good morning all. Thank you very much for inviting me for this debate today about this very current issue around the world, which regards the use of the failing firm defense in the COVID-19 post-crisis. For sure, it is a very hot topic for many jurisdictions, and it won't be different here in Brazil. I remember that in our antitrust law, we do not have specific provisions about the adoption of the failing firm defense in Brazil. Although we have a soft law concerning this issue, so the failing firm defense, it is written in our merger guidelines, and it has been used not by the solely ground for ruling or for closing some operations in Brazil, but I can remember something like about 18 cases on which this failing firm defense was used as an argument. All these cases in Brazil, they were not approved on the grounds of the application of this firm because there were other arguments which could, which enable CADE to close the transactions for analysis of, for example, rivalry or unlikely to abuse of market power, for example, in some markets where the prices are in commodities like internationally defined. So it's without of question that the failing firm defense, it fits the constitutional provision of the economic order in Brazil. So if the requirements that are described are used in other jurisdictions can match some operations in Brazil, it is very possible for the Brazilian authority to make its judgment on the grounds of the failing firm defense. So I remember, for example, that in order to improve the social welfare and getting more efficiencies, if the recovery or if the bankruptcy is something imminent for a firm, and it was successful to prove that there wasn't another less competition harmful exit for that firm. And it also can prove that the exit of these assets of the relevant market will decrease the consumer welfare, the well-being. It can be approved, but it is, of course, that the undertakings will have to struggle to prove that they match all these requirements, because in CADE we have discussion that is growing about this failing firm defense, which we did not apply it fully so far. So as far as I remember, in the discussions on the administrative court and also in the general superintendence after the pandemic starts, we didn't face any argument of failing firm defense. So I also remember that we do not have such an experience like other jurisdictions, like, for example, in the US, where this failing firm has a legal provision and it's applied since 1950s. So in CADE, we can for sure apply this in our constitutional order. So with these few words that express my own idea, I can't speak on behalf of CADE today. I thank you for this time, and I look forward to hear from the other panelists and for the audience. Thank you, Bruno.
Thank you, Commissioner, for your initial words. I'll pass to Caio Mário to give the Brazilian perspective of the discussion as well. Caio, please.
Thank you very much. Thank you, Bruno and Fabiana and Lauro, for the invitation. Thank you, IBRAC. It's always a pleasure to participate in these webinars. And I think if there's one thing the pandemic has helped us with is keeping this dialogue closer to our friends from overseas as well. So it's great to have Rafique, Ethel, and John here with us today. So just my initial remarks here, I just want to lay down the ground for some of our debate. It seems to me that the failing firm defense is usually treated as an ugly duck of the competition law by most competition authorities. It's there, it does not look particularly attractive, and to the extent possible should be disregarded, I think. I think that's the general feeling regarding the failing firm defense. And my feeling is that that's because no competition authority likes to say explicitly that they are proving a merger because the firm is failing and there is no other alternative, even though there will be concentration effects due to that merger. This has led to a situation where the failing firm doctrine may be in the background in an implicit manner, but many times it will hardly be treated as a central point in the discussion. This is certainly true for Brazil. Because of this perspective, even the parties will tend to avoid making that a relevant point of discussion many times. So, and here I think CADE is no different from other agencies around the world and has been referring to the failing firm defense in a very cautious and restrictive way in the cases that it faced it. In order to prepare for this discussion, I also went back to to Caio's case law, knowing that it's hard to find explicit mentions to the defense and even less in explicit acceptance or application. Depending on how you count it, you have between 10 and 20 cases that mention the failing firm defense. But in most cases, it was simply rejected or applied implicitly or in the background, but not directly tackled. In my reading, there is no really straightforward acceptance of the defense in a particular case. And I agree, I think, with the reading of Sergio, of the commissioner, regarding this point. So we don't have deep experience in applying the failing firm defense in cases. In this case law, Caio developed some detailed criteria to evaluate the defense, very much inspired in other jurisdictions. And then it also consolidated this criteria in the horizontal merger guidelines, as mentioned by Commissioner Sergio. Generally, these cases mention at least three factors. So the imminent insolvency, which means the major financial problems in the near future. So it's always short-term looking. Second, the genuine difficulty of going through a bankruptcy or reorganization process that would allow the company to survive, which means actually showing that in the absence of the transaction, the assets will leave the market, limiting supply and impacting consumers. And then finally, that there is no other less restrictive alternative available. And here the firms need to show that they pursued other potential alternatives, but they were not there. Also, as pointed out by Márcio Oliveira in his recent paper with Luis Esteves, the horizontal merger guidelines highlight the additional need to show non-net negative effects, right? So that's an additional need to show that the exit of the failing firm will be worse than the market concentration generated by the merger. And the burden of proof here falls on the companies. These are very stringent tests, and they've been taken with a lot of caution from the authority, not only in Brazil, again, I think also elsewhere in the world. We're going to hear that from our colleagues here as well. But these stringent tests may take the defense out of the table too quickly. In some exceptional situations, and here I'd like to highlight, I'm talking about exceptional situations. I think everybody discussing failing firm defenses are not saying this is a normal situation or this should be frequent at all. These are really exceptional situations. The fact that a firm's failing may be very important in the analysis, whether the competition authorities expressly acknowledges it or implicitly takes this point into consideration. So it may be important to evaluate the competitive effects. It's certainly important to evaluate the impact in the face of the alternatives. It is also important to evaluate what is the space for remedies, how could you design remedies in that particular situation. So it's important in many different levels. And in my view, to the extent that the situation is important, it should be expressly acknowledged. Indeed, this acknowledgement makes clear the analysis taking place under exceptional circumstances. So I think this is in favor of both the parties, the authority, and how the authority is signaling to the market how that particular merger is being analyzed. This avoids taking that particular precedent as business as usual and signaling that other similar cases in normal circumstances would have the same treatment as that particular case. So if that case is exceptional, it's important to acknowledge that. It's important to acknowledge that the background is relevant for that particular decision. I think this is more transparent and less distorting. So in my view, especially moments like this, where companies may face very challenging situations in the near future, we don't know yet. It is a different crisis than 2008, 2009, as you have more liquidity in the market, but you do have very deep crises in some sectors. I do think it's important to tackle the defense straightforward. It certainly should be exceptional. No one, I think, would defend that this defense should be common or should be used fairly often. But it should not be ignored or artificially excluded from the discussion. I think that's the perspective that should be good for a discussion in this particular debate. I mean, when should we acknowledge it? how should we acknowledge it and use it and not simply avoid it? So I'll pause here and allow the other panelists to have the brief introductions, and then I think we can go back to the discussion. Thank you very much again for inviting me. Thank you for this great discussion.
Thank you, Caio. It's very nice to have an overview from Brazil, from Sergio and Caio. And then I move to the panelists to John to have a US overview of this failing firm defense.
Thank you very much. And thank you to IBRAC for inviting me. IBRAC has become a very well-known and well-respected institution around the world. I'm very, very pleased to have this invitation, so thank you. I agree with everything that Caio and Mário just said. I think there's a lot that is left out in the discussion of failing firm defenses because it is, as the current the current director of the Bureau of Competition has said, it's often made but rarely accepted. And so we see a lot of debate, a lot of discussion, a lot of analysis, but very little implementation of failing firm defense in practice, and even less in case decision law. And I think for the exact reason that Caio and Mário said, in order to accept this affirmative defense, the commission, the agency, has to essentially accept and acknowledge that it is allowing an anti-competitive merger to go through. And that's a very difficult thing, I think, for an agency to say. They'll find almost any other reason to justify the merger going through before they acknowledge that they have let an anti-competitive merger go through. And we can come back to that. In the US, the conditions for failing firm are really the same as every other jurisdiction I've looked at. And it's possible that the US was the progenitor of these conditions, but they're really very common. The inability to meet your short-term financial obligations, which means you're running out of cash quickly. Secondly, that you're not able to reorganize in some fashion under the bankruptcy laws, which means that the absent a transaction, the assets would leave the market entirely, disintegrate, if you will. And thirdly, that there's been some effort, good faith effort, to find an alternative buyer that would be less anti-competitive than the transaction that is being reviewed. So I don't think we see a lot of difference in conceptualization in different jurisdictions about what the conditions should be. In fact, it's pretty interesting because there might be more unity on this aspect of merger control than on any other aspect of merger control across the board, competitive effects or standard of proof or anything like that. And yet you see almost no implementation of it. So maybe the agencies just haven't had enough experience to disagree yet. But maybe that will change as we go forward. In terms of how COVID will impact the analysis of the failing firm defense, the Federal Trade Commission has made it very clear that they do not intend to loosen the reins on this defense at all in light of the COVID crisis. There was a very brief statement made by the director of the Bureau of Competition in May of this year, in which he has said that they will not relax the conditions in light of COVID at all. He highlighted that they have heard this defense raised many times about how a firm is going to fail, it's going to exit the market, it doesn't stand a chance to recover. And then when the merger is not approved, suddenly there's what he calls a miraculous recovery. And so they are skeptical, to say the least, about failing firm defenses being put forward. And they've got experience, I think, behind that because, desperate times call for desperate measures, and even very unsuccessful firms will find some way to carry on. And lastly, which I thought was quite interesting, is they put a shot across the bow of lawyers in the private bar not to bring these arguments forward frivolously. They essentially say, look, we expect that you will do your diligence before you bring these claims forward. And we will hold you to your credibility on these issues. So if you bring these arguments forward and we find them to be unpersuasive, and in the end, the company doesn't exit the market, we're going to remember that. And we're going to remember that you came forward and said that the assets were going to exit the market. So I can hardly imagine a stronger statement by the US authorities that they will be skeptical, to say the least, about failing firm defenses coming forward during the COVID crisis. Now, we could have a lot of discussion about whether that's appropriate or inappropriate. I do think there are going to be instances where failing firm will be very important to the analysis. And maybe I shouldn't even say failing firm, but what I think Mário was getting at is it is really important to look at what the counterfactual is here in the absence of the merger. And the counterfactual of a failing firm, of course, is that the assets leave the market. But even in the instance of a firm that's not going to exit the market entirely, its future may be one where the competitive dynamic changes a lot, where the prior competitive vitality of that organization has changed completely, and it will no longer be able to constrain competition in the same way it did previously. It's sort of had a limb cut off, and it's not going to be able to run the race at the same speed it used to. And those are the kinds of dynamics that I think do come into play and are very important in discussing the counterfactual situation and should be brought to bear and be an important part of the discussion. Now, the last thing I will say is that the US has almost no case law on failing firm decision because if the agency accepts that the firm is going to fail and it approves the merger, it does not have an obligation to publish a decision. So there's no reasoned decision obligation under US antitrust law. And so where it's accepted, we don't see discussion of it. And it has been introduced a couple of times in connection with mergers that have gone to trial, either on a preliminary injunction or permanent injunction basis. But it's never been the basis for the decision. So we find very little beyond the theoretical discussion of the failing firm defense in US law. And so the dynamic really plays out in terms of the negotiations with the agencies. I'll pause there and thank you again for having me. I look forward to our further discussion.
Thanks a lot, John. These are indeed very strong statements from the authority. I wonder for further debate whether this is taken by the political environment in the US, but that's for our further debates here.
Politics never enters into it in the US, never.
Okay. Okay, so I'll pass the word to Rafique to tell us a little bit about the European experience.
Thank you, Bruno, and hello, everyone. Also like to thank you all and IBRAC for the invitation. I've been at IBRAC before, physically rather than on a screen, and I must say it was slightly more enjoyable than this experience, but this one is great too because we're having a good discussion. I think what was said earlier is something I also see from a European perspective. It's not any different, as it were. I agree with what Caio was saying, with what John was saying. There's not only consistency among the authorities in the application of this principle, but there's, I think, also consistency in the views that have been expressed so far. From a European perspective, again, the test, I'll run through it very quickly, is not any different from the tests that are being applied elsewhere in the world. It's a 3-limb test, as it were. The first is that the failing firm, would be forced out of the market because of its financial difficulties. The second is that there is no less anti-competitive purchaser out there to acquire the business itself. And the third, that absent this particular transaction, the assets themselves will inevitably exit the market. There's an underlying current to that, which is the market share would, at least part of that market share, would inevitably end up in the hands of the acquirer, as it were, in terms of impact on the market. Now, if you're looking at Europe to provide a lot of experience on failing firm, you're not going to find that much either, I'm afraid. Yes, there is an obligation here in Europe for the European Commission, at least, to issue a reasoned decision. So a little bit different than what John was explaining in the US. But if I've got my numbers right, since the early 1990s, there have been 4 cases only that have been cleared based on the failing firm defense. The last one was in 2013, which was the Aegean Olympic Airline deal. And I can't say that in the last 7 years or so, there haven't been any failing firms out there. They have, but there has not been any decisions on using this particular defense. Now, that doesn't mean that you wouldn't find the defense featuring in a number of cases that are out there and being rejected as being relevant. And that you'll be able to see from reading the decisions coming out of the European Commission, where the Commission has expressed, in no unclear terms, I would say, a view that the conditions which I went through earlier have not been met, and therefore the failing firm defense was simply not available. What you wouldn't see from a number of decisions, and I've been involved in two cases where a somewhat watered down version of the failing firm defense was used and did impact the outcome. And it's something which we are referring to more as the flailing firm rather than the failing firm. So it's a watered down version of the financial difficulties that the company's in and its relevance in the market at the end of the day. That has had an impact on the outcome. Part of the counterfactual assessment, but it's also had an impact on the remedies, as Caio was mentioning earlier, in terms of the scope of the remedies that are needed to address the issue that has been identified as anti-competitive. The other point to mention, again, is bringing this poll back to COVID, given this is why we're having the discussion. Again, in similar vein to what John was explaining, the voices from Europe are, again, don't expect us to accept this defense easily or lower the standards simply because of COVID. And here I'm quoting Commissioner Vestager, who said, the crisis shouldn't be a shield to allow mergers that would hurt consumers and hold back the recovery. We've got another quote from another senior official at the Commission who says, lessons from past crises, including the lessons learned from the Great Depression, so it's going back quite a while, show that we face a serious trade-off, short-term relief, but possibly a slower recovery due to lasting anti-competitive structural changes in the market. So very clear messages, I would say, from Brussels that the rules of the game have not changed and don't expect them to change as a result of the crisis. I think the last point I would mention, though, is are we going to see more of these cases? What's the expectation, at least in Europe? And that's a little bit hard to assess. My own feel is that no, we're not going to see many at all, and that's due to a number of reasons. First, again linked back to Caio, something you said, which is yes, this is a crisis, and yes, there are companies in difficulties, but it's not a financial crisis. There's plenty of money out there. There are many programs around Europe of state recapitalization of companies. There's a lot of political pressure on banks to make funds available. And therefore, whilst certain industries are suffering quite a lot, we're not in a world where so many companies are going bankrupt, on the verge of bankruptcy, as it were. The other element to this is that soon after the crisis, at least the governments of the big economies around Europe essentially hit the pause button on a lot of the bankruptcy laws, and therefore withheld the danger, as it were, of companies going into bankruptcy on technicalities and on the grounds of the laws as they stood at the time. Now, this pause button is expected to be released in the autumn sometime, so I think that's a time where it's worth recalibrating and seeing whether what I've just said actually still makes sense or not. But time will tell. But again, my expectation is that I don't see a lot of shift in this regard. But I do see that the theory of failing firm or flailing firm would, in the weakest of cases, provide the mood music during which, or that's impacting the assessment of the deal, and in the best cases, having an impact through the counterfactual assessment and possibly a knock-on effect on remedies. So I'll pause there and hand over to others and look forward to the discussion.
Thank you, Rafique, to put the perspective from Europe. And I would like to pass the word to Ethel to have the word from the UK, the perspective from UK, especially with the CMA, which is the authority there. And what is the standard under this current situation? If you can just talk short for a brief.
Yeah, absolutely. Thanks, Fabi. Thanks, Bruno, Lauro. It's always a real pleasure to be back in these IBRAC events. They make me feel closer to home. So yeah, it's really great to be speaking to all of you guys. So I'm still getting used to the fact that we have to refer to the UK outside of Europe, but yeah, it is the bar is still very high here, and the same things that John and Rafique mentioned for the US and Brussels apply here as well. The CMA has in fact published a refresher of its position on failing firms to remind people of what the views are, and to remind people that the views are still the same. They still have the pretty stringent conditions that Caio, John, and Rafique mentioned. And in this refresher, they explicitly say that the pandemic has not brought about any relaxation on the standards by which mergers are assessed by the CMA. So, I mean, as far as the competition authorities are looking at failing firms, seems like things are pretty much business as usual. No changes in the short-term horizon. So as Fabiana mentioned, what I wanted to discuss in this brief introduction is, let's assume that things will remain the same and they will not relax the standards. So will the current conditions actually make it easier for firms to satisfy this three-stage test that is pretty similar across jurisdictions? And that follows from some of the points that Rafique just made. So if you think about the first stage, which is exit is inevitable, I think it actually might be harder for a firm to show that it's facing significant financial difficulty and satisfy this first limb, at least here where you have significant financial support being offered by the government. I know things might be different in other jurisdictions, things might be different in Brazil, but here you have tax deferrals, furlough schemes, you have a number of grants being given. So it might be harder for you to actually show that you are facing these financial difficulties that would make you exit. This is not to say that people are not suffering, firms are not suffering. The lockdown means consumers are not consuming as much. Some sectors have experienced a significant reduction in their revenues, and therefore they are likely to be unable to cover their costs. But as Rafique said, and I completely agree, the overwhelming amount of support that is being given might be harder for you to say this financial support did not work and that's why we are in this situation. When it comes to the second stage, whether there are no less and competitive alternatives, and again, following on from some of the points that Rafique made, I think that on the one hand, the current conditions may make it easier for the firms to convince the authorities that they searched around and they only came up with one option. And this is largely because the situation is so dire for some of these firms that they don't have a lot of time to be shopping around for alternative purchases and go through due diligence and all of that. But then again, there are a number of companies with deep pockets out there willing to take advantage of the situation, which, as others have pointed out, is one of the differences between this crisis and the previous one. So I'm not sure the current conditions will make it easier for firms to satisfy this limb. Now, the third one is one that I think might actually be easier to satisfy. This is the one where we talk about whether the competitive effects of the merger would be worse than if the firm were to exit. And I guess, again, it all goes back to the counterfactual. I completely agree with John on that. I think that if you have a counterfactual where you potentially have more exit, you have less entry, then it is more likely that the customers of the target would actually have switched to the acquirer in the event of exit. So if that is the case, then the merger would be unlikely to lead to a substantially less anti-competitive outcome than the exit of the firm. But just to summarize, I mean, even if the standards remain as they currently are, I think it will continue to be difficult for firms to put forward a successful failing firm defense.
Thanks, Ethel. I think you've raised a good question for our later debate, which is whether the standards we have shall apply or we are in a very different situation. But that's for our later debate. I'll pass the word to Marcio, which will explain us his proposed screening test and make some arguments around it, which he drafted with together with Luis Davis. So, Marcio, please.
Okay. Well, good morning, everyone. Thank you, Bruno, Fabiana, and Lauro for inviting me for this seminar. Well, if I may, I would like to use a presentation to talk about the screening test that we proposed. I think it will be easier for everyone to follow me if I have the presentation. So I'll share my screen with you. Okay, can you see it? Yes, Fabiana?
Yes. You can just,
Okay, so very good. So let me start talking about the motivation for coming up with this screening test. Okay, so it's basically focused on the criteria used by competition agencies to identify failing firms. We noticed that these criteria are backward-looking in the sense that competition authorities are always looking at a firm's past performance. So this can lead to false negatives because the agents have two hypotheses. Well, hypothesis 0, the firm is failing. Hypothesis 1, the firm is not failing. Okay, so agencies try to prove the hypothesis 1, that the firm is not failing, by relying on firm's past performances. But following a significant crisis as the current one, a firm past performance loses information value to make forecasts, basically, because we have what's called a structural break, right? So by using past data, the agencies can consider that a firm is not failing when in fact it is failing. So the agencies can wrongly accept their hypothesis that the firm is not failing, and they can make type 2 errors or false negatives. And how to avoid it? In our opinion, by relying on firms' current performances. And this is the goal of the screening test that we came up with. And basically, as I said, we're interested in identifying failing firms. So we came up with a screening test proposal that relies on firms' current information, not on past information. And the focus of this screening test is on what we call a variable of interest, which can be turnovers or profit margins, for example. And the variable of interest is equal the value observed minus the value extreme. A negative variable of interest means that most probably the firm is failing. Let me talk about the values here. So the value observed is the average value of the result variable after the shock, okay? And it shows a firm's current performance. On the other hand, value extreme is the extreme negative value for the result variable. This is the minimum return or the maximum loss that a company was willing to accept when it made its risk analysis.
Marcio,
and sure,
I think
please.
Slides are not moving here. We're still at slide 2. So if you can move them.
Okay, yeah. I will. I have moved it, Bruno. Thank you, but it's probably something with my connection. Let me stop sharing and start sharing it again. Okay?
Yeah, maybe. Okay. Yeah. Mm-hmm.
Okay, let me do it again. Okay, there we go. Share. Okay. Which slide do you see now, Bruno?
Slide 5.
Slide 5.
Okay. So good. So let me get back to slide 4 to emphasize that, I'm interested in the variable of interest. If the variable of interest is negative, it means that a firm is most probably failing, all right? So now, do you see slide 5 there? Yeah? Okay, good. Okay, so, the value observed is the average value of the result variable after the shock. It shows a firm current performance. Value extreme, on the other hand, is the extreme negative value for the result variable. This is the minimum return or the maximum loss that a company was willing to accept when it made its risk analysis. It's distant from the average, and therefore the probability associated with results inferior to value extreme is very low. And how do I know that? By assuming that the result variable follows a normal probability distribution. Most values are close to the average, are near the average. You can think of an example, for example, people's heights. It's very rare to find someone very short or very tall. Most people are close to the average because the probability distribution of people's heights is normal, right? So that's my point. And getting back to the variable of interest, a negative variable of interest means that a firm's current performance is worse than the negative extreme it planned when it made its risk analysis. That means that its investment has stressed. It means that the company is most probably failing. So if that happens, I think that we have identified a failing firm. And consequently, its acquisition should be eligible for a failing firm defense analysis by a competition agency, mainly if market concentration is not too high, right? So just to finish here, I think that we ran a counterfactual analysis here. We are comparing a firm's current performance to the lowest acceptable value of its risk analysis. And if the firm's current performance, is worse than the lowest acceptable value of its risk analysis, well, most probably that company is failing. That's our point. Just to conclude, I would like to say 3 things. First, we do not expect the agencies to produce this kind of empirical evidence. I think that firms should do it, and firms should present it to the competition authorities. And if firms do that, the burden to rebut the empirical evidence would be on the competition agency. And that's basically, an overview of the screening test that we came up with. Thank you very much.
Thank you, Márcio. I'll just ask you to stop sharing.
Okay, I'll stop sharing. Good. Thank you, Bruno.
So I think we had all the initial comments. A lot for our debate already has been said. So I think now we enter in the second phase of this event, which is some questions that we are going to throw for 2 panelists to comment. And then we'll reserve some time in the end for questions from the floor as well. So I'll ask that anyone that has questions, please send on the chat room for me and Fabiana, so then we can raise the questions in the end of the event. So the first question I'm going to throw is for Commissioner Sergio and Caio Mário, which is basically a question on whether the Brazilian standard provides for a greater challenge than the ones put in other jurisdictions. What's your understanding about it? And what is the level of evidence that is expected by the authority in order to take failing firm arguments into account in your experience? Please, Commissioner.
Bruno, thank you very much for the interesting question. Well, since we probably will face this debate for the first time, that probably will be almost close to on a huge crisis, seriously take account the adoption of this failing firm defense. It is expected for us to demand a high level of proof, so it will demand a high burden of proof on behalf of the undertakings for sure. As I mentioned before, of course, the use of this defense, it fits, for example, the social function of private property and the free competition that are some constitutional principles that we have to apply. And, I remember that we have also jurists and economists on the CAGE's administrative court. So some arguments will be more feasible to some of them, some to the other, but for sure, the level of the counterfactual, since that we have other public policies that may tackle the effects of this post-crisis. Remember that we are talking about, preventing the market and the competition. Of course, that we do not wish to have a high concentrated market because some assets are leaving the relevant market, but will these assets be useful for the new economy later? I mean, will everyone, for example, still fly as much as we fly, for example, for business, now that we have, for example, these virtual meetings? So there are many considerations that we have to take in mind. For example, there is money now in the world. So what is exactly the necessity of some assets in the market? So what is the truly goal of the competition policy? And what is the goal that must be identified and worked on other state mechanisms. So I really do believe that CAGE will still demand a high level of counterfactual, high level of burden of proof. So I really do believe that it is a very common theory. So what we have to do is really identify, for example, what is the net benefit for consumer. So if we allow such a concentration, so sometimes we'll have some assets that belong to public, that belong to private. So each market has one dynamic that these assets can continue on this relevant market. So everything will demand some proofs, and we will need the best efforts of the undertakings even to make our minds. Well, I hope I have answered your question, Bruno, and thank you again.
Thank you, Bruno, for the question. This is an excellent point, and I think it deserves attention. And thanks, Commissioner, for the comments. I do not think, and from what we learned from John, Ethel, and Rafique, I don't think the Brazilian standard is necessarily more stringent than other jurisdictions. I do think that there is remarkable convergence in the discussion of the criteria themselves, like the standards for analysis of the failing firm defense. So I think in this particular situation, all competition authorities are taking the defense with a lot of caution and looking at more or less the same factors. Said that, I do think there are important challenges for presenting that. I don't think they're special from Brazil, but I think they're especially important in Brazil because of how the failing firm defense was not so much explored in the case law, and it was usually taken either implicitly or fully rejected. So let me just mention two examples here for the debate. The necessity to show imminent failure and the impossibility of corporate reorganization through bankruptcy this may be a big challenge sometimes, especially if the merger is exactly the situation, the solution to a particularly complex reorganization, right? So usually authorities are in the bad spot of taking a decision in a very uncertain time and under very uncertain conditions. And part of these conditions is evaluating the short-term impact of a crisis that might lead a particular firm to exit the market. Of course, we're talking about situations where there is a high likelihood of leaving the market. But yet, it's very hard to predict the outcome of a corporate reorganization many times, especially complex ones. So deciding at the time of the merger whether that is possible as an alternative or not is very challenging. And how to set the burden of proof of that, I think it's very challenging as well. The other point that I think is of course very important whenever applying the failing firm defense, and I fully agree with Commissioner Sergio on this point of the counterfactual, which will always be important. We're always evaluating the merger in face of the alternatives and what would be potential alternatives. Depending on how we set the burden of proof regarding counterfactuals, it may be even more complex here. I mean, we're always talking about merger control in a prospective manner. We're always looking forward and trying to make predictions, what would happen. In the case of failing firm defenses, we need to think of at least two counterfactuals, right? If there's no merger at all, will this firm exit the market? And what's the impact of exiting the market for consumers and for the market in general? And would there be another alternative of another merger or another a transaction that would be better than this one that would actually be able to happen? I mean, these are very, very big question marks. And how we deal with them and how to set the standard of proof, I think it's quite important. And just to finalize with one example, I think in the case of Petrobras, Petromax, João Paulo Rezende argued that the simple fact that there's no other bidder or no other contender to acquire the assets was insufficient as showing that there's no other alternative, and tried to argue that in his vote. I think it's very hard in a situation like this, if you have only one interested party to acquire the assets, to require the parties to show a much higher burden of proof of saying, look, no, you could have tried better. You could have gone after many other potential buyers or anything like that. It starts being an exercise that is never ending. So I think the big issue here is not about whether we should look at counterfactuals. Of course we should. And I fully agree with the Commissioner Sergio that this is always going to be an important issue. The question is where we set the bar. Where have we looked far enough to understand that it was so difficult to have any other alternative, that this is really a reasonable solution for the particular problem that's on the table. And I think those are the challenges that we have in calibrating these tests and these standards, and not just leaving them at any point. So that would be my view on this. We need to calibrate that and to make a better balance here.
Thank you, Caio. Thank you, Sergio, for the really, really interesting point. And I'm going to move forward to a question for the economists from Ethel and Mário regarding this rationale of the failing firm defense. We know the deterioration of the competitive structure of the market that follows the merge in case of the failing firm defense is not caused by the transaction, but from the prevailing conditional economic situation. So affecting the target. So it's a different situation. It's not from the transaction, but for the economic situation here. So we're expecting to indeed to have a black swan here. Also, how to deal with the failing firm defense in face of the COVID, in the COVID outbreak. I know that is a different compared to the the previous crisis in 2008 was more financial crisis. Now is more economic. How to deal with this kind of differentiation here? And are the current standards the ones that should apply on non-standard situation? So if you can have on this from the economics perspective from this question here. Thank you.
Shall I go first?
Yes.
Please, Ethel. Yes.
Okay, sure. Well, to be honest with you, I wonder whether the current standards are the ones that should be applied, period, regardless of COVID or not. And there is something that Caio mentioned that actually is related to some of the things that I want to say. And sorry, Sergio, you're the only commissioner in the panel. This is not aimed at you whatsoever. It's general. So competition authorities, they seem to require a lot more certainty in order to accept a failing firm defense than when they are finding that a merger is problematic in certain circumstances, like when you're looking at potential competition, which is something that everybody has been talking about as well, particularly because of nascent acquisitions. So if you consider the language of the third limb of the Commission's criteria, as Rafique mentioned, it requires that in the absence of the merger, the assets of the failing firm would inevitably exit the market, emphasis on inevitably. So this seems to require a lot of certainty. And it's certainly more than what seems to be required for the finding of a substantial lessening of competition or significant impact of effective competition or whatever the criteria is, that the standard is, in the case of, for example, potential competition. So, I mean, taking a step back and ignoring COVID, I would even challenge if the standard is fit for purpose, because it seems to be too stringent and there is this asymmetry. But put that to the side. I mean, to be honest, I think it's still too early to say whether the standards should and need to be relaxed to address the difficulties that were brought by the COVID crisis. We're going to get into some cases later, which will highlight my skepticism of the sort of jumping the gun on this. I mean, I do not disagree that COVID has caused simultaneous supply and demand shock and may indeed have structural, long-lasting implications in the economy worldwide. And going back to the level of competition that you had pre-crisis might simply not be possible, right? I think Sergio mentioned people might not fly as much as they would before. This is just one of the examples. That said, it's not yet clear, at least not to me, what the impact of the crisis will be and whether the standards need to be relaxed to facilitate a failing firm defense for going forward. And as a final point, I think that whether competition authorities will change the rules or not may also depend on the extent of political pressure. I mean, the whole debate you had after the Commission prohibited Siemens Alstom and whether the merger should have been allowed to create this European champion shows that the Commission is resisting this pressure. But I think we need to wait, as painful as it might be to say, to see how this crisis evolves and the overall impact of the economy. I think there is obviously a question about whether this is all temporary, whether this crisis is likely to have this long-lasting structural effect I mentioned. I mean, are we going to have another lockdown in the winter that is coming for us? This will significantly change things. But to be honest, I think it's difficult to say right now. Mário?
Thank you very much. Well, let me start by defending Commissioner Sergio Ravagnani, although I don't have the power of attorney to do so. Well, authorities, regulators are very risk averse, and that's normal. When I was with CADE, I was also very risk averse. So it's their job to do so. Okay, so I'd like to start by saying this. But well, regarding the question, this is a serious and unexpected crisis. So, and due to this crisis, some firms will fail, and being sold to a competitor may be the only alternative for a non-strategic exit from the market. And well, if competition authorities block this exit and a firm fails, production capacity will fall. And therefore, the remaining firms' shares can rise exactly before production capacity has fallen. So competition authorities should consider this possibility when assessing a transaction, even though, as I said, they have to be risk averse. So if the current standard for dealing with failing firms is not appropriate, I think that firms themselves should look for another standard. But, competition authorities will not do it. As I said, they are risk averse by nature, and so I think that the firms should propose different standards for a non-standard situation as the current one. Well, just to finish, regarding the situation in Brazil, I think it's too soon, to make any forecasts about, the number of firms that will fail and, how many firms will try to use the failing firm defense argument. The situation here is a bit different from Europe. There is also a lot of liquidity in our financial markets, but credit provided by public banks has fallen significantly since 2016. For you to have an idea, credit provided by public banks in Brazil, was 11% of our GDP back in 2015. Today is 7%. So it was a drop of approximately 280 billion reais. And we need to make this credit channel work again, but it's become rusty because it hasn't been used over the past 4 or 5 years. So that's a big challenge for the government, and I don't know if we will be able to restore that channel in a timely manner. So I think there's still a lot of risk for companies in Brazil, and perhaps we are going to have to talk a lot about the failing firm defense over the next year or 2 years. Thank you very much.
Thank you.
Can I just make a very brief comment?
Sure.
Yeah.
I think, and this applies to me as to everyone, I think we have to be a bit careful, at least in my mind, when we refer to the standards and whether things have to change. Are we talking about those 3 limbs? Are they too stringent and we need to relax them a bit? Or do we need to move away from them and try to come up with something else? Because I understand, for example, from your research, Mário, that you are coming up with potentially an alternative, but which is in a way linked to the exit scenario, because your financial situation is just so poor that you're going to exit. So in a way, this is linked to the first limb, right? And then what I was thinking is, let's say but you apply the test, and no doubt, competition authorities would argue with us economists whether the calculations were right, and there will be lots of discussions, boring ones between us economists. The lawyers will completely doze off. But what I'm trying to get at is, let's say you apply your test and you see that the firm is not failing. Mm-hmm. There is still a potential consideration with the anti-competitive effects of the merger, which is related to the counterfactual. They might not fail and exit, but they might be a pretty poor competitor going forward. And that alone might allow you to put forward a merger that was sort of borderline and competitive, or might allow, as Rafique was saying, gives you more flexibility on remedies. So I'm just a little bit worried that if we say, let's just put to the side what we currently have, come up with something new, which is a bit automatic, and you don't allow for these nuances, which are case specific, like the counterfactual assessment, which obviously can allow you to put through a flailing firm, which has been done in the past in many cases, and allows a merger which is sort of borderline to go through. But yeah, I think the point is, let's just be cautious with the terminology and what exactly we mean by that.
Okay.
Thanks for your comments, Ethel and Marcio. I think we got a very interesting dynamics here. So in the benefit of that, I have a question to John and Rafique. Sorry, to John and Caio, which that the debate now is whether the current standards apply. So I'll leave you open to comment on that if you wish. And the question is, as Caio has mentioned, that the one of the issues is, in his view, to cut much more on calibrating the standards, the burden of proof, than actually changing the standards. But giving one step back, the question is, what are the practical difficulties that, in your view, the companies face when they have to take this failing firm defense arguments to the authorities?
Well, thank you, Bruno. I'll give that a shot first. But I think I can maybe tie this together a little bit, because I agree with Ethel that there's a distinction between what the agencies define as the standard for sustaining a failing firm defense and what the law defines as the standard for a merger being anti-competitive, right? And that's substantial lessening of competition or something akin to that. And there may be a difference in what you can do with that depending on whether you're in an administrative jurisdiction or a prosecutorial jurisdiction. So, for example, in the US, if we felt we had a very strong failing firm case, and even if we didn't meet the conditions set out in the merger guidelines, we could still take that case to court and argue that the merger would not result in a substantial lessening of competition, irrespective of whether it met the technical definitions of failing firm defense in the merger guidelines. Now, in Europe, you may not have a realistic chance to do that. Yes, you could do it, but by the time you ever got to courts to review that, the decision of the commission, your merger is dead and gone, and the company is you've probably proven your point or not in terms of whether the failing firm has actually failed. But I do want to talk about some of the practical implications of bringing this case forward. So my first piece of advice on advancing a failing firm defense is don't do it, right? As we talked about before, it's kind of the last refuge of decision-making for the agency. And so you want to give them every opportunity to decide on some other basis. Market definition, competitive effects, entry is quite a good one when you're talking about something like failing firm, oftentimes. And foreign supply can often be very important. And keep in mind that you've got to read your audience. So in my view, there are kind of two types of case handlers. You have the case handler who is willing to challenge your deal and the case handler who is looking to challenge your deal. And the one who is willing to challenge your deal is also willing to not challenge your deal and willing to accept some other reason not to challenge your deal. Whereas the one who is looking to challenge your deal is going to reject your failing firm arguments almost out of hand, right? So if you're in the second case, you need to kind of have your failing firm argument, as someone said, I think Rafique said, background music. I like that term. But if you have someone who's actually willing to consider failing firm defense, I think you've got to give them both a strong failing firm defense and some other justification. And I'll give you a quick anecdote. This was quite a few years ago. I had a merger involving a company in the steel industry. They made steel bars. And they had 5 straight years of cash losses on their books. The income statement was just a sea of red. And we brought this forward and showed it to the agency. And they came back, because this was a second request situation. And they said, well, look, you're projecting a profit for next year. So obviously, you don't meet the conditions of failing firm defense because you expect to have cash to meet your short-term obligations going forward. And you don't expect to go into bankruptcy. And so we had to come back and show them the budget projections for every one of the 5 preceding years, which in every case showed that there would be a profit next year, right? It's kind of like rooting for a bad sports team. It's like, well, we're going to be better next year. It has to be better next year. It's going to turn around next year. And when we showed them these projections for each of the previous 5 years, where every time it had been wrong, I could just see this look on the case handler's face like, we have nothing left, right? That was our trump card, and we've just played it and we've lost. And what he said to me was, tell me again about Japanese imports. Because he was looking for any other excuse he could find to justify internally why he should let the merger go through. And ultimately, he did let the merger go through. As I said, we don't get a reasoned decision, so there's no explanation to you as to why. And just to end that anecdote, 3 years later, the company went bankrupt anyhow and went out of business, and the assets were sold and dispersed. So he was right to let it through, and we were right about the failing firm. So I think as a practical matter, you have to anticipate what you're going to hear in response from the case handlers and the case team, and on what basis they will challenge your failing firm defense. And you've got to be able to respond to that, respond to it in real time. And at the end of the day, you still have to look for some other reason to give them to justify the approval of the merger. I think that's really the most effective way to do it. There's just one other point maybe to make before I hand off to Caio, and this is not so practical. But I do think in the current environment, while the standards will still be the same, and Ethel, even if they should be changed, I don't think they're going to get changed in the short term. Hopefully, the COVID crisis will be over before the agencies can change these standards. But I do think there will be opportunities where the agencies, or at least the governments, want to use this as a hidden tool of industrial policy, right? I think, Rafique, you mentioned the last time it was used in Europe, it was in connection with an airline failure. That's kind of a prime example of where you might have a government sort of encouraging the use of this doctrine to justify something they want done. The same is true, I think, with the Siemens-Alstom merger. That was the, again, background music of that is, we have industrial policy reasons to consider this. And if we do see it in the short term, I think that's probably where we're going to see it. So if you've got that type of case, you might be in a better situation to try to advance it than if you have your typical, industrial merger.
Let me just join the conversation here. Thanks, John. I mean, I fully agree with the perspective that John's bringing, and I'd just like to make 2 or 3 additional comments, actually, on the same direction. So regarding standards, I also do think, and just to pick up from there, I also do think that it's very hard to see a big change in standards, and I confess that I'm a bit skeptical of that, especially in the Brazilian context, where we have little experience with these standards that are out there already. So I think you need to have more experience with these standards before you have big changes. Although I'm sympathetic to proposals like the ones from Mário of saying, let's think about tools that can make it more concrete to look at the different aspects of these standards, and that can make it more reasonable to define what's the right balance in looking at these standards, right? So I think we're still going to have these standards for a while. I think it will be hard to have a big change, but I do think that we could make them better and apply them better and calibrate them better in the way that I've been proposing in this discussion. Said that, and moving to the practical difficulties of the question of Bruno and the issues tackled by John, I think the first and foremost, the practical difficulty is really the negative bias towards the failing firm defense. So I'm fully with John on this, that saying, look, it's very hard for an attorney to advise any client to say, look, this is the best and the most important argument that you have in this merger is pushing for a failing firm defense, okay? Because there is a negative bias towards the defense up front. So many times what this negative bias is doing is actually pushing attorneys in on the opposite direction, is really dealing in this way that Rafique and John mentioned as, okay, this is a background or contextual element that should be taken into account, but let's focus in all other arguments that are available and not tackle this directly. As I mentioned in my first comments, I don't think this is particularly the best way. I think this is the most pragmatic way because of what the case law looks like today. But I do think this is one of the biggest practical challenges, and I think it would be good if we could have more straightforward conversations about the situation of the companies and what's the impact of that situation for the analysis, not only about a failing firm defense as a defense itself, but also on how to recalibrate the way that we're going to look at entry, the way we're going to look at different levels of these analysis, rivalry. What's the rivalry if the company is in such a bad shape that it's not going to keep being a real rival to that in that market? So those are the discussions that I think that are important. And just to make a final comment, I think a major challenge, and I think I mentioned that in the previous question, is how to discuss counterfactual in a context of a lot of uncertainty, right? So here, really, we need an error cost perspective to look at counterfactuals. We need to calibrate type 1 and type 2 errors. We need to understand that decisions of the authorities are going to be under uncertainty. Nobody's going to know for certain if, one, that firm is really exiting the market, two, if any other alternative would be a little better, a lot better. So there's a lot of uncertainty in these discussions. And I fear that there is a very strong bias towards false negatives. So, like, if there is any error, let's simply block this merger. Let's incur in a false positive, but not in a false negative, right? And my view here is that how to frame this in a way that we can actually balance false negatives and false positives, because sometimes false positives are going to be terrible in certain markets. I mean, having that firm exit in the market may lead to very bad situations that not necessarily are better than allowing the merger. So I think this would be a practical challenge in my view as well, Bruno. Like, how can we balance the different type of errors, understand and acknowledge that we're deciding under uncertainty, and that the burden of proof should be allocated in a way that it is still feasible. Otherwise, the burden of proof becomes so stringent that it's equivalent of simply not allowing any discussion around this context. So I think that's the challenges that I think we face, and we face in Brazil, and I believe we face in other jurisdictions from what we're learning here from Ethel, John, and Rafique.
Thank you, Caio. It's a really good point to make it like this, how to balance the type of errors. And I think the counterfactual would be very good to put more discussion on this challenge from the failing firm defense. So moving forward to the European overview, you have two recent cases that have been spotlight on the European debate regarding the failing firm defense. One is the Amazon Deliveroo, and the second was the Asian Olympic. Are these good or bad precedent for what's coming? If Rafique and Ethel could be give some highlights on these two cases, would be nice to have it on the discussion.
Ethel, do you want to go first on Amazon?
Yes.
No, okay. I mean, AG and Olympic, I'll be brief on that. It's, as I said, it's a case dating back to 2013. Focus on the name of the case, AG and Olympic 2, not 1, because 1 was blocked by the European Commission. So this was their second go at going to Brussels and saying, can we please get this through? This was ultimately approved by the Commission against the backdrop of a severe financial crisis in Greece. And ultimately, the Commission, where it did come out, is whilst Greece is a fantastic holiday destination, it did actually conclude that whilst there may be some slots which are quite attractive that Olympic owned, that it will go out of business, and it'll go out of business pretty soon if the approval didn't come through and AGN didn't buy it, and the conclusion that it would shut down because there are no other buyers.
Thank you, Rafique. It just reminded me, I'll go to Amazon in a second, but there was one thing that reminded me, the fact about you looking for alternatives. In previous cases, I think Ilva might have been one of them, maybe even GE Alstom, not strictly speaking failing firms, more like failing divisions, perhaps. But there was a discussion that the Commission looked back at the time when the acquirer was considering acquiring the target. And they said, oh, look, back then there were other bidders. So why are you telling me now that these bidders are not interested anymore? And I think this is a dynamic that you have to take into account, because maybe 6 months ago, 1 year ago, there were other bidders, but now there might not be any other bidder is interested. And in particular, in the case of COVID, maybe back then, yes, there were, and now with COVID, people just don't want you anymore because your sector is so doomed or something like that. So it is difficult for you to prove this particular item as well. But on to Amazon and Deliveroo, I think it's a very interesting one, because I don't know if you know the story, but Amazon purchased 16% minority stake in Deliveroo. Deliveroo is like iFood in Brazil. It just delivers food from restaurants to customers. And the two theories of harm that the CMA raised were that this minority stake could damage competition by discouraging Amazon from re-entering this particular segment. Amazon had been active in food deliveries from restaurants, but they exited about 2 years ago. So the question is, would they no longer re-enter because of this minority share in Deliveroo? And it would also discourage Amazon from further developing its offerings of online grocery deliveries. So the reason why, as Fabi mentioned, this got so much attention is because the CMA provisionally cleared the deal in April. The way the process works here is the CMA issues provisional findings, and then it goes on to a final decision. So the first provisional findings actually approved the deal on the basis of a failing firm defense. The CMA concluded that Deliveroo had been hit so hard by the COVID crisis that they would stop online food deliveries absent the cash that was being injected by Amazon, and they would have left the market. It's also, just as an aside, it's important to note as well that the CMA did not go on to discuss whether the merger would have been anti-competitive or not, and it was failing firm that saved the day. They sort of stepped away and said, we don't have to look at the anti-competitive concerns that we had raised before. We're just focusing on the failing firm. That's a topic for another seminar, whether you need to go back and provide some guidance on that. But anyway, back to the failing firm. The CMA received, as one may expect, a number of third-party complaints. Then it extended its review and issued a revised provisional findings back in June now, provisionally clearing the merger again, but not on the basis of failing firm. On the basis that Amazon's stake was really small, it wouldn't be able to exert material influence on Deliveroo, and competition wouldn't be harmed. But what is interesting for the purposes of this discussion is that the CMA looked at additional market evidence, they argue, and they say that they found evidence that the market conditions and Deliveroo's financial positions had changed between April and June. And it was no longer a failing firm. So the CMA acknowledged that they sort of rushed into this because of the poor financial situation and the urgency to sort it out. But then a further assessment later on indicated that, and this is my view, not the CMA, that this might have been just a little hiccup in the financials of Deliveroo rather than a significant inability to compete due to the financial situation. So the reason why I find this case interesting is that it ties back to my point earlier about it potentially being too early for you to tell whether the rules have changed. And it makes me a little bit concerned because the CMA now has learned a lesson of what happens if they rush into things and they approve a failing firm. And it might make them a little bit more wary going forward, which might make things even harder for those actual failing firms that are out there and for whom being purchased is the only solution. But let's see, as I said, let's wait for the winter, maybe another lockdown coming in where we will know how serious the situation really is. Hopefully not serious, but you never know.
Thanks, Ethel. It's very interesting, the timing that they took their first decision, and that they might have looked to the market to see what was going on with Deliveroo during this time, and they thought again about the case. So perhaps the situation we'll face here is a bit different on the post-crisis scenario that we'll have. but certainly will be something that the authorities will review before taking their decision. And I think the debate is quite interesting on the standards, and I would like to continue on this. And I'm not willing to put Commissioner Sergio in a difficult position here, so I'll raise the question in the conditional that if we were to agree that the current regulations should not be applied in those exceptional times, then what should be the standards? And I throw the question to Commissioner Sergio and also Marcio, and Marcio, of course, he may use his ex-commissioner hat or his economic consultant's hat now. So up to you.
Thank you, Bruno, for your kindness. Of course, we may speak in these terms, of course. Well, if the current standards are no longer feasible or no longer useful for appreciating the transactions, so first of all, we have to be very clear, the authority and the undertakings and the economists and the practitioners, that of course we cannot see the future, so we have to assume risks. But these risks, they can be ponderated, they can be calculated, and we have a lot of tools for that. So I'm very glad for hearing from the other panelists, for example, the screening test proposed by Marcio and the degrees of the standard of proof that were detailed from Caio. So the important really is that we can achieve the best for the welfare. So if for the regulators these standards can be proved to be so stringent, I think another economic theories or another proposals must be seriously analyzed from both parts.
Thank you, Commissioner.
Okay. Well, thank you for your question, Bruno. Let me just before I answer your question, Bruno, I would like to get back to Ethel's previous comment, right, on the screening test that I have proposed. Ethel, I fully agree with you. I think that if the variable, if interest is negative, it means that a firm is in dire straits. It may be failing or not, but it is in dire straits. That's my point. All right. And perhaps, as I said, perhaps not failing, but it's flailing, right? So in any case, I think that this should be considered by competition authorities if the companies present empirical evidence about it. And also using this opportunity and about what Rafique commented on, I think that, competition authorities have all the expertise to deal with this kind of information and with this kind of evidence, Rafique. And they can accept it or rebut it. It's up to them. But yes, I think they can deal with it. No problem at all, right? Okay, but getting back to your question, Bruno, and since you mentioned the two hats, I will wear both of them here. And let me start speaking as a former regulator, right? So when we were writing the current CADES merger guidelines, during that was in 2014, 2015, and we thought, we have to have a section about failing firm theory, but there isn't much to say, about it. So in our defense at the time, no one expected a crisis such as the current one to happen. And this is one of the reasons why, you won't find detailed procedures to deal with the failing firm defense in the guidelines. Didn't raise much concern at the time. But and also, the Brazilian competition law does not have specific procedures for using the failing firm defense. And, now I speak as a consultant. I believe that exactly because the law and the guidelines don't say much about failing firms, the competition authority, in this case CADE, can consider that these times are exceptional, and it can depart from the traditional standards. It can use different standards. But again, I would like to say that authorities are risk averse. I doubt that CADE will depart from the traditional standard unless it is provoked, unless it is presented with robust empirical evidence. So let's see what happens. Thank you, Bruno.
Thank you, Márcio. Thank you, Sergio. I have now the last question before you go on from the questions from the audience. But I think it's really nice discussion. What you can learn by now, that's still a really challenge, defending from defense on the current situation. And I have a last question to John and Rafique. So what happens if the failing firm defense would like it to work? Should the defense be used to the firms to get better remedies if it's the only alternative? And how the authorities to be prepared to take such elements into consideration? So how to do with the remedies and how to put the failing firm defense in the remedies to have more view on this topic. Rafique and John?
Yeah, happy to tackle that, and I can be brief. I mean, I've experienced that in practice, not necessarily putting it forward as a failing firm defense that will get you a better outcome, but definitely as a flailing firm background and analysis, more than the mood music that I was talking about earlier, because it has to be much more concrete than that. But I mean, as we all know and we've all experienced, in most cases that we work on, there's always some margin as to how the case is assessed, how the anti-competitive effect is determined, and what the necessary remedy is going to be to achieve clearance, and at which stage of the process. So it's never so black and white. There's some margin for maneuver, as it were. And I think the financial situation of a target company should feature in the assessment of, well, what is the scope of the remedy that needs to be offered in order to get clearance? To put it very crudely, it's essentially a flailing firm discount to the scope of the remedy, not a term that I think you'd see an authority refer to, definitely not in a reasoned decision, but essentially that's what it boils down to, is let's be realistic in terms of the assessment of, for example, market shares. What does the market share really mean in the context of a company that's not doing well, that is close to bankruptcy? And what is the increment that needs to be removed in order to allow the deal to go through? And I think that needs to translate into ultimately a discount, but more importantly and more fundamentally as a policy perspective, into a proper assessment as to what does this really mean in practice, what impact is it going to have on the market, and therefore what is proportionate in terms of requesting or agreeing to a scope of the remedy that otherwise may be somewhat different in terms of scope. But I'll leave it at that, and John, maybe you want to jump in?
Sure. So I could imagine scenarios in which a failing firm defense would come up as a question of remedies. It would require, of course, some situation in which it wasn't a unitary asset, a single production facility, for example, but something that either had multiple divisions or regional businesses or retail outlets or something. And there being some differentiation in the performance of those different divisions or different regional operations. And I suppose if the condition for a failing division is that it have sort of persistent negative cash flow, as well as sort of having been shopped, you could see an agency saying, well, we view these businesses as segregable, and we'll accept, if you will, not formally but informally, accept that certain parts of them are failing, would have to go to the acquired parties, but others of them may not be failing. And those could be sold separately. They would have to meet, of course, in the US at least, the requirements of being sort of an ongoing business concern in and of themselves. So you'd have to sort of almost have divisions that didn't have a network effect or some other cross benefit that helps sustain them. But I could see it coming into play that way. So either in the positive, as you said, Rafique, from the party standpoint, where you get sort of a flailing firm discount, or in the negative, where the agency says, I'm not going to accept the entirety of the proposed acquisition because some parts of the acquired business are segregable and are not failing. And we think those could be sold elsewhere to another party without harming competition. So I think it could come up. And I think as a practical matter, it would be very fact specific, but it's an interesting thing to weave into the analysis. And Rafique, I think you're right that it could definitely play into the dynamic.
Thank you, John. Thank you, Rafique. I think we have two questions. I think one is Lauro. We have one question from Lauro. Lauro, do you want to do it directly, and then Fabiana will do the next one.
Mm-hmm. Thank you all for the speeches. It was great to hear. One question I have, especially for our foreign colleagues, it's in case that the failing firm actually files for bankruptcy or reorganization, and the courts approve a reorganization plan, which involves the sale of the company for a specific buyer, would be any deference from the antitrust authority to the court decision and to the situation of the creditor that has approved and developed the reorganization plan in the different jurisdictions?
Well, I'll speak up only because I have that exact situation right now. In fact, I'm involved in a matter where there was a bankruptcy plan reorganization, a proposed sale to a specific buyer, which is the biggest party in the industry, and the agency was challenged with whether to step in at that stage and do something, or to let the transaction close and try and do something afterwards. And what I will say is this, it's not just a question of competition issues at that stage, it's also a question of the practical procedural implications of the bankruptcy proceeding. And those are likely to be different in different jurisdictions. And so if, for example, the agency were to step in and delay the closing, and as a result of that, the creditors were to force the liquidation of the assets, that would be something the agency, as you can imagine, would view as a very negative consequence of their actions. And so sometimes, they're sort of sitting on the head of a pin in terms of what to do, and they're a little bit damned if they do and damned if they don't. And so it's a great question, and the complexity of the bankruptcy procedure can have a big impact on not only the competitive analysis, but the actions of the agencies, and create quite a dilemma. And in that scenario, unlike most other scenarios, at least in the US, the bankruptcy judge has a huge amount of decision-making authority on whether to accept the proposal of the agency to delay the closing or not. And they're not acting in the interests of consumers. They're acting in the interests, it's their mandate to act in the interests of the creditors. So it's a different dynamic when you're in a bankruptcy proceeding. I'm sure it's very specific to the individual jurisdiction, but it creates some interesting situations.
Lauro, maybe just to comment from a European perspective. I mean, in Europe, obviously, you've got the European Commission. Its very administrative process is looking at the matter, investigating it, and then eventually taking a decision. And it's doing so based on competition grounds, not on other grounds. I'm aware of only one case over the years, and that was quite some time ago, probably more than 10 years ago, which is very similar to the facts that you've just set out. There is some wiggle room in the EU merger regulation that would allow you to go and apply to remove sort of the suspension obligation from the notification process. And I'm aware of only one case where that has actually succeeded. One of the reasons why it hasn't succeeded, or there are not more cases and examples, is because the Commission would typically tell you, let's work on an accelerated timetable in terms of the pre-notification process and get things moving very quickly, rather than make that submission and dissuade me from using the tool that I normally use, because that could take longer. So they would work with you. There is some sympathy there to work with you on accelerating the process and finding a solution, because for the same reasons that John just explained, it'd be pretty embarrassing for the Commission or any other competition authority to be the trigger for a company going bankrupt.
Thank you, Rafique. The last question that I have is to Sergio, is one from Daniel. Would the authorities to be more receptive to the filing firm argument coming from the third party waiting to buy the asset? And the last one, with the same to Sergio, is from Elizabeth Farina. How to address the shareholder and the consumer interest in a filing firm context? How CAD should consider both interests?
Well, very interesting questions. Thank you very much. Of course, the idea is that we have the same view from the arguments, whether they come from the undertakings, whether they come from the third-party interested. So always when we have these debates, they are always rich for us, even when they come with other points of view and other economic studies. So from the perspective of the regulator, for sure, as more information, as more studies, as more debate we have on the case, on the procedure, for us, as better.
Thank you, Sergio.
Thank you, Sergio. Thank you all. I think we are approaching our time here. And I think that we should show our foreign panelists that Brazilians are very strict to timing, and we are finishing
sharply.
Very sharp, yeah. So I think it was a great debate. I think we are just in the beginning of exchanging these ideas. I think we have a lot to see and a lot to learn from other jurisdictions. We have to, of course, watch to see how this crisis and the post-crisis recoupment will play in these different jurisdictions. But I think we should all be very open-minded to solutions that will be positive to the competition environment in Brazil and everywhere else. So I think this debate has contributed a lot for this. Mm-hmm. I thank you all. And let's perhaps in 6 months or so come back here and rediscuss whether anything we discussed today makes sense and should have been applied.
Exactly. Maybe some concrete case that you can discuss. I mean, for everywhere, maybe.
As I always say here in Brazil, we say that one thing exists, but we don't know. We call cabeça de bacalhau or codfish head. Because we know that it exists, but we have never seen it. So I hope that in 6 months we have some good signs that it actually exists. The failing firm defense actually exists, because we all hear about it, we all know that it exists, but we have never seen it. That's the cabeça de bacalhau for us. Thank you.
Yeah. Thanks so much for everyone here.